Welcome back to the deep dive. And if you're tuning in, I know you're expecting the daily briefing on Bitcoin. Well, today, December 15th, 2025, we are doing a much deeper dive because the market is just fascinating right now. We're in what some analysts are calling a structural bifurcation. Now, that sounds like a lot of jargon, I know.
It does, but it's actually pretty simple.
Right. It just means we have these two huge forces pulling in completely opposite directions.
Exactly. On one hand, you have all this short-term macroeconomic fragility, the stuff that makes people nervous.
And on the other, you have this incredibly strong long-term institutional entrenchment. The big corporate money just keeps showing up.
So the price action looks weak, but the accumulation is stronger than ever.
That's the friction we need to unpack today.
Yeah.
Our mission is to really dissect that technical slide below $90,000, look at the surprising macro catalyst out of Asia, and then weigh all of that against what's happening with corporate treasuries.
And that phrase structural bifurcation is, well, it's exactly why we need this briefing. Because Bitcoin has, it's fundamentally stopped being just a high beta tech proxy that blindly follows the NASDAQ 100.
It's evolving.
It is. It's becoming this hypersensitive gauge for global liquidity conditions. This wasn't just a price dip. This was a sophisticated liquidity event with, as you said, geopolitical roots.
Okay, so let's start with the technicals, the real pain point. Bitcoin just could not hold that $90,000 anchor.
It really couldn't. And it consolidated there for a bit, but then it just cracked.
And what's really interesting, what stood out to me in the data was how it happened. It was a slide on what, relatively low volume?
That's the key. That low volume is the biggest clue we have, and it's why I don't think this was, a full-blown panic.
Okay, so unpack that for us. Low volume on a sell-off. What does that actually signal?
Well, think about a high-volume sell-off. That's capitulation.
Right, the V-shape.
The classic V-shaped recovery. Everyone rushes for the exits, weak hands fold, and you often get a quick, sharp bounce. This was different. This was a vacuum of liquidity.
A vacuum. So the big money didn't rush out. They just vanished.
Precisely. The large-scale institutional buyers, the ones who usually have huge limit orders sitting there to catch a falling knife, they just pulled them.
They went on strike.
They went on strike. They weren't actively dumping. They just decided, you know what, this price is too high, and they stepped away to wait for a better entry. They're telling us they want to buy, but lower.
That's a really calculated move, not a fearful one.
Absolutely. And because of that, $90,000 has completely flipped its role, which is so crucial for you to understand right now.
The polarity principle.
Exactly. What was once the floor is now the ceiling. It's immediate overhead resistance.
So anyone who bought above 90K is now trapped.
They're trapped long. The moment the price gets back to their entry, they're just looking to sell and get out at break-even. That creates a lot of pressure.
So what do the bulls need to do to fix this?
To restore the structure, it's not enough to just touch 90,000. You need to see a convincing high volume close above 92,500.
That's a big buffer zone.
It is. We call that $2,500 gap the supply overhang. You have to chew through all that selling from the trapped longs before you can move higher.
Okay, so if the bulls can't reclaim that level soon, where's the real danger zone? The analyst I read pinpointed the $87,000 to $88,000 band.
That band is so critical because it's the cost basis for the November accumulation block.
So that's where a lot of recent buyers got in.
A lot of them. If the price slips below 87,000, pretty much everyone who bought in November is suddenly uniformly underwater.
And that's where the psychology shifts.
It shifts dramatically. You go from conviction holding, thinking it's going to the moon, to pure risk management. Your finger gets very itchy on the sell button. Stop losses start triggering.
And if we break that 87K level, I'm guessing the drop is fast.
Very fast. A break there would likely trigger a rapid repricing down toward the $84,000 to $85,000 region.
Why is it so specific?
Because the charts show a liquidity gap in between. There's just very little historical trade volume in that range. There's nothing to slow it down until it hits the next major support zone around 85K.
That paints a very clear picture of the immediate risk. But let's zoom out because, and this is where it gets really interesting for me, Bitcoin got weak over the weekend, while U.S. stocks were pretty buoyant.
A major decoupling.
Which just screams that the driver wasn't coming from the U.S.
No, the primary force was what analysts are calling the Sunday liquidity squeeze. And that came directly from anxiety over the Bank of Japan's next policy meeting.
The market's starting to price in rate hikes there.
Seriously pricing them in. And that takes us right to the yen carry trade.
Okay, so explain the mechanics of that. I mean, for years, investors have been borrowing Japanese yen for basically nothing.
For next to nothing, because rates were near zero. So they borrow all this cheap yen, and then they plow that money into higher yielding, riskier assets all over the world. Bitcoin was a prime destination for that cash.
So walk us through the unwind. How does a policy meeting in Japan actually translate into selling pressure for Bitcoin?
It's all about the cost of repayment. As soon as the Bank of Japan even hints at getting hawkish, the yen strengthens.
So the loan they took out just got more expensive to pay back in their home currency.
Precisely. Suddenly, the whole trade is riskier.
Yeah.
So to get ahead of it, they're forced to unwind. They sell their profitable risk assets, like Bitcoin, to get the cash they need to buy back that strengthening yen and close out the loan.
And that explains why Asian trading desks were selling while the U.S. was quiet for the weekend.
It explains it perfectly. It's a risk-off rotation that starts in Asia.
But I saw another really interesting correlation this time, linking Bitcoin to emerging markets, specifically the Indian equity markets.
The Gift Nifty Index, yeah. This is a newer development.
The theory is that high net worth individuals in India are using Bitcoin as a kind of hedge against volatility in the rupee.
That's exactly it, and it's a key development. So when liquidity tightens in Asian equities, and India's a huge player now, these investors sell their local stocks.
And they sell their Bitcoin hedge at the same time.
At the same time. Not because they don't believe in Bitcoin, but because they need cash fast to manage their bigger portfolio risks.
So what's the big picture takeaway from that?
It means Bitcoin's entire profile, its beta, is shifting. It's becoming this complex hybrid asset.
A crisis hedge in one place, a risk asset in another.
You've got it. It's a flight to safety for emerging markets dealing with currency issues, but it still acts like a tech stock in developed Western markets.
Okay, so that's the short-term pain. Let's pivot now to that other side of the coin, that immovable wall of corporate adoption that makes the long-term case so bullish.
The bullish divergence, yes.
And we have to start with Strategy Inc., formerly MicroStrategy. They continue to just be this persistent floor for the market.
They're an unbelievable force.
They just bought another 10,645 Bitcoin for almost $1 billion.
$980 million. Their total stack is now over 671,000 BTC.
It's hard to even comprehend that number.
It really is. They're just systematically taking supply off the market every single month, no matter the price. That programmatic buying puts a hard floor under everything.
And something that's structurally critical is that they retained their spot in the NASDAQ 100 index.
That is mainstreaming on a level people aren't talking about enough.
Why is that so important?
Because all the passive index funds and ETFs that track the NASDAQ 100 are now forced to indirectly buy Bitcoin exposure. If you have a 401k that holds a NASDAQ tracker, you now own a tiny piece of Bitcoin, whether you know it or not. That passive bid is incredibly powerful.
And we're seeing this move beyond just holding, right?
Yeah.
We're seeing active treasury management. Take SpaceX, for example. They just moved $95 million in Bitcoin to a custody address linked to 21 Capital.
And the nuance there is so important. They're not just buying it and locking it away in cold storage for a decade.
This suggests they're doing something with it.
It strongly suggests they are actively managing their Bitcoin collateral. They could be borrowing against it to fund operations or maybe engaging in yield strategies. It validates Bitcoin not just as an asset, but as functional, working collateral for a major corporation.
And that activity also serves as a reminder that all this supply is essentially locked up.
It's locked in corporate vaults. It reduces the free float, the amount actually available for trading. And when demand comes rushing back, that lack of sellable inventory can make the next move up incredibly sharp.
This isn't just a U.S. phenomenon either. In Brazil, their largest bank, Itaú Unibanco, just made a huge shift.
A material shift in conviction, yes.
They're now recommending an allocation of up to 3% in Bitcoin.
3%. That is a serious number. We've moved way beyond the 1% toe dip we saw a few years ago. For a major bank in Latin America, that's a massive vote of confidence in Bitcoin as a real portfolio hedge against currency volatility.
Let's shift from the financial side to the physical network itself. We saw a sudden 8% drop in global hash rates.
Down to 718 exahashes, yeah. And that was linked to some emergency power rationing back in Xinjiang, China.
But the real story here isn't the outage, it's the AI pivot.
That's the structural change this event really brought to light.
So the intelligence suggests miners in that region are liquidating their Bitcoin ASICs and pivoting to GPU-based computing for AI.
It's pure economics. They can make more money, a higher revenue per kilowatt hour, by servicing the AI boom right now.
So what does that imply for the Bitcoin network?
It implies that the exponential growth we've seen in hash rate might be capped through Q1 2026 as all this energy capacity moves over to AI.
That sounds like it could be a security concern, but you mentioned a strange benefit.
Well, it doesn't threaten security. The network will adjust. But here's the paradox. If the hash rate growth stabilizes, it actually makes life easier for the remaining public miners, especially in the US.
Less competition.
Exactly. Less pressure to constantly upgrade, more stable rewards. It could be paradoxically bullish for them.
And on the regulatory front, seems like the cleanup phase is continuing. We saw expanded charges against Bitcoin Rodney and the hyperfund scheme.
Which is just net positive for the market. Analysts overwhelmingly see this as a good thing.
It builds trust.
It builds trust, reduces systemic risk, and funnels capital toward the regulated products like the ETFs. It's the space maturing in real time.
And we also saw the UK set a target date of 2027 for full integration.
A long timeline, but it's a clear, staged approach.
Right.
Stricter marketing rules are coming in 2026. It just shows this global, methodical move towards standardization.
Okay, let's end our analysis with an idea that is, I think, fundamentally challenging the core dogma of Bitcoin for years. It's the death of the halving thesis from Marcus Thielen at 10x Research.
This is a big one. It's intellectually disruptive.
The old story, the standard belief, was always the 4-year halving cycle. The supply shock is what drives the price.
And that theory is now being seriously challenged. The argument is that the market has matured beyond that. I mean, mathematically, the impact of these halvings is getting smaller.
Right, going from 1.8% inflation to 0.9% is just less of a shock.
Much less of a shock than the early days. The new reality, according to this analysis, is that we're in a political and liquidity cycle. They show data that suggests Bitcoin's price is now almost 100% correlated with global M2 money supply.
So central bank liquidity.
It's all about central bank liquidity. It's not a tech asset cycle anymore. It's a pure monetary gauge.
So if this is right, what does it mean for you, the listener? The actionable advice seems pretty clear.
It's crystal clear. Stop watching block rewards and start watching central bank balance sheets. The future of this asset is now tied to global monetary policy, not a mining schedule.
Okay, let's try to synthesize all of this. It's a really complex picture.
It is. You have this acute near-term bearishness, the 90K failure, the yen-carry trade risk clashing head-on with this long-term, overwhelming structural bullishness from corporations like Strategy Inc. and banks like Itaú.
So what's the immediate tactical advice?
Right now, the onus is completely on the bulls. The technical structure is broken. Until 90,500 is reclaimed with serious volume, the path of least resistance is down.
So any downces are suspect.
Treat any counter-trend rally this week as a liquidity fetch, a trap to bring in sellers, not a real breakout.
Which means defense is key.
Defense is absolutely key. The primary tactical recommendation is to have defensive stops below $87,000. If that line breaks, the immediate target we're all watching is that $84,000 to $85,000 range. That liquidity gap is real.
That shift in thinking from a supply shock asset to an M2 money asset it's profound. We started this by saying Bitcoin is shedding its skin.
It truly is.
So I'll leave you with a final provocative thought to mull over. If Bitcoin is no longer driven by the halving cycle, but is now almost perfectly correlated with global central bank liquidity, does that mean Bitcoin has finally completed its evolution? Has it moved from a fringe tech project into the world's most transparent, real-time barometer of currency debasement? We'll see you next time for the next deep dive.